Well, good morning. My name is Jim Mosquera. I'm the VP of Corporate Development at Alliance Corp and also the founder of Alliance University. Today is actually our very first event at Alliance University. It is an executive briefing. The thought with the briefings is, as the name would imply, to keep it brief, and hopefully we'll get done certainly in under 30 minutes. Alliance Corp is actually a family of three companies. We've got Alliance Technologies, which is involved with managed IT services. Alliance Systems performs web and application development, and Alliance Advisors provides C-level type support services and talent acquisition, and as well as Alliance University. The title of today's presentation is called How Much Can They Spend? Recently in the United States, there was a approximately $2 trillion spending bill that was passed by Congress under the label of COVID relief. And one of the things that I know that I have been asked recently on social media and just from people at large is, and you've seen this also talked about in the news media, is this coming wave of inflation because, we've spent $2 trillion on this. There were obviously more trillions that were spent last year. In an essay that I put together a little over 3 years ago in February of 2018, where I predicted the next president of the United States, not by name, but by party. And, one of the things that they would do is I said that the $1 trillion deficits that we might see and during that time, actually, would be in our rearview mirror. So we would be having deficits and, of course, additions to the U.S. budget that were multiples of that. So what we've seen the last couple of years is not really a surprise for me. Perhaps the surprise is under what banner, was it done? What I'd like to illustrate first is this chart, which is courtesy of the Federal Reserve, and it shows you what the total public debt is of the United States on the federal level. It's instructive to point out that this doesn't include all of our debt because there are unfunded liabilities which are basically things that will come due in the future that are multiples of this, but let's just focus on this for now. You see that we have several lines on the chart that are depicted by arrows. And each arrow, if you notice, has a certain slope to it, so rise over run. And if you look at each individual arrow, you'll see that it gets steeper than the preceding one. I've also taken the liberty to mark some historical points of emphasis here with the alphabetic letters, and I want to highlight each one of those for you. Letter A refers to again roughly the start of this first line, this first arrow. It's around 1971, historic event that occurred there that I think a lot of people will probably ignore from the Nixon administration, which was not Watergate. It was actually something that he undertook in August of 1971, which has decoupled the United States from a monetary agreement that had been set, some 25 or so years before that. And then you can see here how the United States debt started to increase at this particular way, as depicted by the line. Point B, right around 1981, 82, we were in the middle of a very severe recession at that time. And it also marked the important point of some economic and credit cycles that I've cited in my books. Point C, dot-com bubble. You actually noticed during the time around C that, our public debt really did not grow. It was actually fairly flat during that time frame. Well, right after that, you notice that it started to increase again at an increasing rate compared to the last time period. D, of course, the great financial crisis, 2008, and you see the rate of increase there. And then E, the most recent increase in debt, which occurred, during 2020 and now spanning into 2021. I titled this slide, Where We Might Have Been. What if we had just continued on the track from 1971, 72, we were still increasing our debt, but we had gone through time, so over the last 40 or so years, 50 or so years at this rate, where would we be? If you take that line and extrapolate it, you'd be somewhere around $4 trillion. Here's what would have happened if we would have continued on the trajectory from the early 80s. And then here's what would have happened with the trajectory from the year 2000 or so after the dot-com crash. You'll notice, like in particular A, if you just look at A by itself, it comes up to the present time around $4 trillion. That's where the debt would have been. Again, if we would have still increased our debt at this rate, some from the early 1970s. Well, this amount of $4 trillion is actually a little bit less than we have added probably within the last fiscal year. So if you think about it, if we just continued on this rate here, since the time of General Washington, for President Washington, we would have added more in the last year than we would have historically in the nation's entire history up to this point. So it just shows you the magnitude of what's happened, within the last year. When does debt hit the point of no return? Well, if you look here, there's another instructive metric that I think people need to look at, which is, well, you might say, okay, we can continue to increase our debt, if our income, if you will, as depicted by this gross domestic product. Well, what if that keeps increasing? And yeah, there's some valid reasons to use that as a metric. And if you can see here, even though I was showing from the early 1970s that our debt was increasing as a percentage of our income, if you will, it was actually going down. And then it started to go up again in that early 80s period. Very much like if you're buying a house and your mortgage payment is $10,000 a month. Well, if your income is $10,000 a month, you're probably not going to get a mortgage on that. But if your income is maybe $1 million a year or more, your debt to income ratio is more palatable. Well, there's a body of research that was done by a couple of Harvard economists, Rogoff and Reinhardt, and they investigated all sorts of financial and banking crises over the course of history, over the course of the entire world. And one of the things they determined was when you get to the 60 to 80% range, that's generally a very uncomfortable, a danger point, if you will. It's when the dashboard starts flashing at you that, maybe you've accumulated too much debt, relative to your capacity, to produce things, your gross domestic product. Well, when you get above 90%, which is the dash line, for them, it implies crisis. And if you look at the United States, since around 2010, so over the course of the last decade or so, we have been at or above that line. We were trending, at this rate for, probably 9 years, and until the last year, then of course you see a dramatic spike where you're approaching 140%. So if you look at, just from the standpoint of some economic research, we're above that crisis level point right now. Now, someone might retort that the land of the rising sun, Japan, has had increasing debt to GDP ratios for quite a long time. And as a matter of fact, they've been above the 90% range, I don't know, probably 25 years or so. And they've been continued to increase their debt levels, again, relative to their income, to the point where they got to like 250%, within the last year or so. It's come down a little bit since then. So you might argue that, well, even though you get above that 90% range, there are some countries like Japan that are very, very capable of sustaining those debt levels. I would tell you that Japan has some unique circumstances, and one of the reasons why their debt has increased as much as it has, their demographic situation is very tenuous. Their population is declining. And if you've ever seen images of Japan or, pictures of crowds in Japan, you'll see there's not very much immigration there. So they're not bringing people into the countries. And if you see foreigners in Japan, generally they're going to be tourists or, business people on short-term stays. So there are some major structural problems in Japan as well. And, who's buying all this debt that they keep creating? Sure, the Japanese people save a lot, but I've read that there have been many instances where the Japanese Treasury issues bonds and there are no takers, no bids. So the Bank of Japan, their central bank has to jump in and buy that debt. This is what I call wizards to the rescue. In my writing, I talk a lot about the wizards. The wizards, just generically, I refer to those in central banking and government as well. And as I mentioned earlier, the Bank of Japan has had to step in and do certain things. Well, what makes, the increasing amounts of debts possible if the general public is not there to buy that debt? Well, this is where the wizards come to the rescue. And this is a chart of the U.S. Federal Reserve, so our central bank, and their assets or things that they've bought. And you'll see there right before the financial crisis, the amount was under $1 trillion, probably in the $900 billion level. Then it spiked right after the crisis and continued to increase up until about 2014, 2015. It leveled out. Then it started to actually come back down a little bit. We experienced a couple of stock market shakeups, if you will, certainly in 2018. And then the Fed reversed course and said, no, sorry, we're going to continue to increase our balance sheet. And up until the time it was 2020, you're probably sitting around the $4 trillion level. Now, if you just look within the course of the last year, they've essentially doubled what they've done before that. Now, this money doesn't just exist in a vault somewhere. This is money that gets created out of thin air. And one of the things that I'll argue with people that talk a lot about inflation is if you look at all of these things that the Fed have bought, primarily bonds over the course, certainly since the great financial crisis, let's say the last 10 years or so, they've added quite a bit. And, we have not had the raging hyperinflation that had been predicted by many. I would argue that the inflation that we've had has been in financial assets. But again, to take a look at this chart and just see what has been when added here, and imagine also if you had taken all of this money that got, again, artificially created, let's say after roughly this point, if you took $7 trillion out of the economy, and again, the purchases that they've made have been relegated to U.S. bonds and then mortgage-backed securities. Imagine if all that money was not there, that demand was not there. What would happen to the value of of the bonds? Well, of course, they would go down. Interest rates would be much different. During the period from 2016 to 2019, we were continually told that we were in this economic boom. But yet our federal debt continued to explode, and that there's some really interesting questions that could be asked. Why was that the case? If you're growing an economy, even under the old Keynesianism, you should be running surpluses during that time to potentially save for a rainy day. But we weren't doing that, and that's something that certainly was troubling for at least for me over the course of that time period, 16 to 19. And I wrote an article in November of 2019, kind of talking about what was going on in the background and how really the stock market itself was probably as risky as it had ever been. But I would tell you that we had a significant amount of what I'll call economic rot, and economic rot I would define as those economic conditions that maybe were exacerbating the income, excuse me, and wealth inequality. Those measures were widening. You had seen more and more, let's say, distress in some of the high yield market. You had seen balance sheets of individuals that were, again, not necessarily healthy. I worked a lot with small businesses. I saw a lot of unhealthy balance sheets, even though the business from the outside looked, healthy. When you looked at the balance sheet, it did not. There were a lot of unprofitable companies out there. Some might even call them zombie companies that were basically surviving through refinancing their debt all the time. So the conclusion that I've come to is, as the slide says, they'll keep spending. There is no friction, if you will. If you look at the gears that are on the slide right now, that's the money-making machine, the capacity of the United States, whether it comes from the central banks primarily or the commercial banking system. There's no throttle there, for that, and that's the reason I had written the article in February 2018. Talking about how the deficits that we would experience, again, in increasing debt, would just simply continue to increase because there was nothing there to really stop it. And a lot of that is based on our monetary system and how dollars come into play, and the special, unique status that the United States has as the reserve currency of the world. Absent that status, this would be much harder to do. Now, the arrow here that talks about theory is something that I've written about, and it was certainly in that 2018 article where you start to hear more about this thing called modern monetary theory, or MMT, and it really espouses that a government can really spend, a government like the United States can spend all the money at once because whatever debt it issues, it can just simply print the money to pay it off, and technically that's true. Now, there are some ramifications to that. But at least from the prevailing theory right now, and certainly the theory that would dominate Washington, and I say that from the standpoint of regardless of which party is in power, whether it's Republican or Democrat, that is a prevailing theory. And the MMT takes it even a step further and says, we don't really even need taxes. We can just raise all the money we want through this other mechanism. And if the economy starts to overheat, then we'll raise taxes. Again, that is the theory. But what we've really experienced with, again, the wizards, as I call them, intervening in markets is a couple of things. Number one, the questioning of capitalism. You see here these protests. It says capitalism isn't working. I penned an essay a couple of years ago that really started to warn about the public and certain political parties would start to blame capitalism for all these ills. But I would argue that we really haven't practiced capitalism for over 50 years. So what we have something now is something completely different. The other thing, besides some of these financial crises that we caused, like in 2008, we have social problems that get created, and as depicted by these two slides. And those things can't be discounted because I've always felt that, politics and economics would come to a clash. It's definitely come to fruition. When I penned my first book in 2010, I said that's going to be really the dominant thing that we need to worry about as a society is, that politics and economics clashing. And I firmly believe that a lot of the social problems that we see today really have their roots in economic problems and things that government has done. And why don't these things work? Well, the main reason is, if you look at this particular slide, we see people, right? Well, we see a marketplace, we see, over here, business. And it's really, really difficult, if not impossible, for the government and the wizards that we talked about before to really know what all of these people want. There are, we know, billions of potential decisions that get made on a daily or certainly an annual basis about what consumers want, what producers want to produce, what the price of certain things should be. And, we don't really have a good transmission mechanism now because interest rates are very artificial and some prices are either potentially too high or too low because of these interventions that have occurred. And it brings to light what I call economic law number 4, which is, markets allow people to satisfy themselves by satisfying others. And if you think about that for a second, the things that we do in a business are really to help other people, but we're trying to help ourselves at the same time. And when you have intervening forces that alter that mechanism, well, we've really messed up the market. And in the previous slide, I showed you that, that tends to bring on some, economic problems as well as social problems. We really, really saw that in 2020 with a lot of the lockdowns that occurred. We disturbed the market and, we didn't allow people to satisfy themselves by satisfying others because we told them, they needed to stay home. And then government had to figure out some plan to redress, their policies. So we end up with the what I'll call the rinse and repeat cycle. The government or the wizards, they try to intervene, and they have good intentions, but there's always unintended consequences to what they do. So they try something happens. There's legislative calls for more action. The action gets taken. Typically, that's going to involve spending money, adding to the debt, and we end up with further problems. And the further we get into this, these cycles, it becomes more difficult to create the same effect that you did before. And, you cause some potential long-term damage, to the economy. So what does the future look like? My predictions are in 2 areas. Number one, I believe in the future that you're going to see some international conference that, again, gets all the major nations of the world, and they decide that, the United States is no longer a viable candidate, the US dollar, to be the world's reserve currency. And again, that's a privilege that the United States has had, since the end of World War II. albeit it was altered, in 1971 by Nixon, as I mentioned earlier. But we've been in a very privileged position for a long time, and with that privilege, though, comes some responsibilities. Well, if other nations see that you're not being a good steward, if you will, by being the world's reserve currency, they're going to take action, and they also know that the United States can use the U.S. dollar as a geopolitical hammer to bend nations to their will. And at some point, not even some point, it's occurring already. Some nations are saying we don't want to play in that game anymore. So I believe that you're going to see an international conference where the United States dollar then basically removes itself, or it gets removed in that capacity as the world's reserve currency, and you'll have something that I'll just generically call world money, where now when nations want to transact with one another, instead of being forced necessarily to have dollars for those transactions, they're going to be using this world money unit. Now, there is a world money unit that exists today, and it is called the SDR, special drawing right. Probably a little maybe esoteric to get into in this discussion, but it shows you that there are mechanisms already in place, again, for the creation of this world money. Now, it doesn't mean the dollar goes away. The dollar will still exist just like these other currencies. But now the United States is in a completely different position, and consumers will certainly feel that, because the dollar valuation, perhaps relative to other currencies, will be different than what it is today. And the dollar necessarily won't be in the same demand. Now, short term, I'm not predicting that, but this is something that I would certainly say would occur easily within the next decade. Again, depending on that debt chart that I showed you earlier, the more vertical that does, the more expedient it becomes, for other countries to kind of demand, hey, we need something else here. The other development that I think is probably equally as important is what I'll call digital money. We are going to have another seminar at Alliance University that talks about cryptocurrencies. And the first one is really for people to understand what cryptocurrency means and what digital money means. I think there's some significant misunderstandings about that. And what we've seen, certainly since 2008, 2009, when a white paper was written and it talked about this peer-to-peer system to be able to exchange value. People know it today as Bitcoin. I don't really want you to focus so much on Bitcoin per se, but the fact that there are mechanisms now to create digital money, to transact, to exchange value. And it's something that can operate outside the orb, if you will, of monetary policy that's dictated by those wizards that I talked about earlier. And imagine that you had an economy that just operates, again, kind of independently, and through whatever exchange of value, whether that's Bitcoin or Ethereum or Cardano or EOS, whatever cryptocurrency it is. I mean, these are viable ecosystems that can survive and are surviving right now outside the orb of what you would consider traditional money. And it further sets up a situation where, the battle will be between, centralization and decentralization versus distributed architecture. And what I mean by that is, when I talked about digital money before in the previous slide, there's other developments beyond just what you hear of, or the traditional cryptocurrencies like Bitcoin. Governments are taking charge as well, and they realize, hey, this is a movement where it works, for one, in math we trust. But they're going to try to centralize that more, and you're going to see what I call flag currencies, or digital currencies that get issued by governments. China's doing that right now. There's been one under study in the United States for some time now, where you'll have a true digital dollar. That comes with its own implications, but it's a centralized architecture. Bitcoin and some of the others are decentralized distributed architecture. So I think one of the things that you'll see in the future is, again, that battle between these centralized architectures, of which one, will certainly be money, or, these things that we use to exchange value, and then those decentralized and distributed architectures. Very important consideration also for some of the things that you see today with social media. Again, the centralized versus the decentralized architecture. So that'll be a theme. It's in play right now. It'll certainly become much more in play in the future. But I think that the message, if you will, for this seminar is there's no friction, if you will, to continue to spend money. There's no friction there, and until that friction presents itself, and again, it can present itself in a number of different ways. I don't think that you'll see any specific fiscal discipline. Again, Japan has been, probably the prime example of that, certainly over the last 20 to 25 years, where, as I showed in that chart, their budget their public debt has just gone, much higher than what we have right now, and that will be, excuse that will be used by those that propose that theory that I mentioned earlier. Is like, hey, we have an example of that, and we can continue to spend, and Japan certainly doesn't have any hyperinflation. All true. But as I mentioned, these actions are not without consequences. And if you look at the last two slides, you'll see again that clash between things that are centralized and decentralized. People that just simply want to opt out and don't want to play in that arena anymore. And we're starting to see those developments. So I'd like to thank everyone today for participating in this executive briefing by Alliance University. We like to think of ourselves as the gold standard, or that modern agora, that place for people to come learn. And we have a number of other programs that are available for seminars and roundtables of different varieties. The purpose of the executive briefings, again, is to share some information at no cost, again, to encourage discussion, that we feel is very, very important in this day and age. So thank you very much, and enjoy the rest of your day.